options pricing and the Black-Scholes model. In episode 2, we're tackling one of the most important equations in finance, the Black-Scholes model. Published in 1973, it changed markets forever by providing a mathematical formula to price options. Myron Scholes and Robert Merton won the Nobel Prize in Economics for it in 1997. A call option gives the buyer the right, but not the obligation, to buy an asset at a fixed price. The strike, before expiration. A put option gives the right to sell. Options are powerful because of their asymmetry. Limited downside, the premium you paid, with theoretically unlimited upside for calls. Before 1973, options pricing was largely guesswork. The breakthrough was this: if you hold an option and continuously hedge by trading the underlying stock to stay delta neutral, you can completely eliminate risk. That risk-free portfolio must earn the risk-free rate. Otherwise there's an arbitrage. This constraint pins down the option's price. For a European call option, C equals S naught times N of D1 minus K times E to the negative RT times N of D2, where S is the stock price, K is the strike, R is the risk-free rate, T is time to expiry, and N is the cumulative normal distribution. The 2D terms capture the probability-weighted payoff. Black-Scholes takes 5 inputs: current stock price S, strike price K, time to expiry T in years, risk-free interest rate R, typically the 3-month T-bill rate, and volatility sigma, the annualized standard deviation of the stock's log returns. All inputs are observable except volatility, which must be estimated or implied from market prices. Here's where it gets interesting. All 5 inputs to Black-Scholes are known except volatility. So traders invert the formula. Given the market price of an option, what volatility makes the model price equal to the market price? That's implied volatility, the market's consensus forecast of how much the stock will move. The VIX is basically the implied volume of S&P 500 options. The Greeks are partial derivatives of the Black-Scholes price with respect to each input. Delta, how much the option price changes for a $1 move in the stock. Gamma, how fast delta changes. Theta, how much value the option loses each day from time decay. Vega, sensitivity to changes in implied volatility. These are the risk dials every options trader monitors. If you sell a call option with delta 0.5, you're exposed to the stock going up. To hedge, you buy 50 shares of stock per contract. As the stock price moves, delta changes, so you must continuously rebalance. This is called dynamic delta hedging. In practice it's done at intervals, not continuously, which introduces hedging error called gamma risk. The model assumes constant volatility, but in reality, implied volatility varies by strike and expiry, creating the volatility smile and skew. It assumes log normal returns, but real returns have fat tails and crash risk. It assumes continuous hedging with no transaction costs. An idealization. Modern models like Heston, SABR, and local volume address these limitations. Despite its limitations, Black-Scholes remains the foundation of options trading. Every derivative desk uses it as a baseline. The Greeks derived from it drive hedging decisions worth billions daily, and understanding it is the prerequisite to everything else in quantitative finance. In the next episode, we'll see how quants use statistics to find edges in the market itself.